Okay, so we're actually at our final panel discussion today. Who's excited about that, right? But it's been some really good information today. So our next final panel discussion is sponsored by InvestNet Yachtly, okay? Here to lead the discussion, financial wellness for the Undeserved, is Jason Hendricks, Managing Director at FinTech Forge. Let's give it up for them.
All right, well, thank you for sticking it out. Some quick introductions. This cast of characters I have with me has been here on stage together several times. So we're going to jump right into it after some quick intros. Derek Tarkowski, Managing Partner at Actuate Law, Eric Jameson, VP of Solutions at InvestNet Yachtly, and Gene Donnelly, who is the Executive Director of FinTech Sandbox. And so I want to call out the elephant in the room. We talk about financial wellness and inclusion has been one of the buzziest things of at least the last decade. But if you look at the metrics, wellness is actually headed the wrong direction. And Gene, why don't we start with you? What's wrong with this country that the wellness is getting worse, not better, for all of this focus?
Yeah, I mean, you could take it religious way, you could take it political way, you could take it so many different ways. No, I mean, I think, when you think about financial wellness and how you define it, a lot of it is how do you, it's the opposite of financial stress, right? It's actually saying what are the things that cause stress to people today, and where do people feel that they belong? And it's that intersection of your financial health, but also your physical health, right? Yep. And that's what really, by encompassing both of those, I think it really causes people to reconsider as we think about healthcare costs and how that has changed, from a society perspective, how we deal with that and how that goes forward, I think has a real inclination of why things are moving the way they're moving.
There's a Pew survey, it's over a decade old now at this point, that said 84% of Americans say either their number one stress or their number two stress is not having enough money through the course of their life. Now, you'd think with that kind of stress and new solutions coming online, that we'd see more movement. Eric, why don't you go next? What's your thesis? Yachtly especially has played in this space for a very long time, with the labs and things like that. Why isn't wellness improving?
Wellness is something that's different to everybody, right? From a financial perspective, I think at times, certainly for myself growing up, wellness to me was, my parents taking me to the bank and introducing me to a rep, right? A teller behind the desk. That was kind of my introduction to finance, right? And then, from there, I think different types of organizations really became synonymous with it, to the point where we are today, where different types of solutions meet different needs. And I think that one size fits all, where you just go to your bank, you have your little passbook and whatnot, has evolved to how do you help people see all their finances? How do you help people get a grasp of where they are and how they fit? And things that they can do to better manage their finances, right?
You would think in this app-based world, right, where there's an app for everything, or in this case, there's a Neo or Challenger bank for everything, and an investment platform for everything, you would think you would see people finding a better fit, to drive part of this wellness. But is it that people just aren't using it?
I think people don't know how to use it. They don't know how to engage, right? So I think about sitting down with an advisor, someone who maybe doesn't have a lot of money. I think someone was talking about investors that maybe are starting off new earlier today. It might have been StockTwits or one of those. We're talking that some of their investors might have $500 or $1,000, right? So sitting down with a financial plan or sitting down with an application and thinking to themselves, well, I only have $500. What do I do with it, right? How do I manage that? Might be intimidating to some people, right? If they haven't been introduced to finances, or maybe they're getting their first job, that might be the first account that they've ever set up, right? Just for direct deposits. So they're just not, maybe not either the apps themselves haven't reached out and grabbed, the person's idea of how to get a better financial position, or people are just intimidated still by some of those types of apps.
Dara, you often have clients dealing with the opposite side of the spectrum, either the people who are, quote your phrase, the credit invisible, or those who've gotten themselves in a little bit of trouble with their use of credit. Why do you think this is still such a pervasive problem?
Well, I think as we talk about kind of the apps and overall financial wellness, what to do with superfluous funds that you may not know how to invest, I think about the really credit invisible. You know, you have extra money to think about investing when you have assets and you're able to leverage those assets, and you know, you can have kind of a more holistic approach to your financial profile. When you're credit invisible, you don't have the opportunity to acquire those assets and create those opportunities to leverage your assets, to even have an opportunity to engage with an application that may improve your overall financial wellness. And the reason, you know, there's a whole host of reasons for why we have 50 million Americans who still remain underserved or underbanked or completely unbanked, and then therefore credit invisible. I think a large part of that is due to, you know, the entire kind of sort of credit bureau and scoring system that we still maintain in the country. But you know, until that changes, and that will largely be driven by lawmakers and regulators' views towards the use of alternative data and things of that nature, so that we can rewrite underwriting models and whatnot, so that we can extend more access to credit without fear of regulatory action. That's kind of my take on it.
So for those who don't know, FinTech Sandbox is let's just assume almost everyone knows FinTech Sandbox. You guys are a strong player. But they provide access for startups who need to tie into data. So Gene, you see a ton of startups in this space. How many are trying to solve this alt data issue that Dara brings up? Are you seeing a rise in the use of alt data?
We're definitely seeing a rise for the use of alt data, the requests for alt data, and kind of looking at different sources. And I think if we think about the underserved and the invisible, part of it is the traditional data sources don't work, right? Like, you know, they don't have a bank account, right? So you're not going to have banking transactions. So to really understand where people are at, right? And what are their distribution methods? How do you reach them? How do you actually get to the point to even connect where they are? I think a lot of it comes back to what we're also seeing is the volatility, right? So a lot of what people are looking for is those measures of that income volatility that people have. So if you're an Uber driver, you know, in terms of your payments and how you, you know, you can't wait every 2 weeks.
Predictability. It's not like you have the W-2.
Exactly.
Right.
So I mean, you know, we can see it in upper echelons in the gig economy as well, but you know, also for underserved, of if there's that much volatility in your income, how can you actually have a bank account and not suffer overdraft fees and not, you know, based on the products that are available today? There's a lot of issues that unless we get those stability cushions from a financial perspective, you know, you can't make that happen. So we're starting to see more and more startups who are trying to address this, looking at consumer behaviors, measuring it. The issue is the data either doesn't exist, so they're using their own data, is their best source typically, some of the larger startups like Propel and otherwise, to really say, how can we make a difference?
So, Dara, flipping back to the data privacy aspect of this, though, when we talk about using alt data, what kinds of issues are startups potentially running into as they're trying to solve this, or even bigger companies around data privacy?
Well, we can start with the state of California, starting on January 1st, 2020, on a consumer's, you know, rights under the new California Consumer Privacy Act, the rights to be forgotten, and that even if a consumer at one point has given you data for whatever reason, and even if you've been compliant with a policy, then at whatever point in the future, they can exercise their rights under the act and say, just kidding, forget everything you ever knew about me, and if the company doesn't have some sort of exception under the law that it falls into, you have to acquiesce to the consumer's requests, and all of that data goes bye-bye, unless you can figure out a way to kind of anonymize it and model it differently such that it can't be tied back to an individual. But that's a compliance challenge, it's a regulatory challenge, and California is state number one. I think there's lots of bills on the floors of lots of states that are maybe not quite as aggressive as California, but still very much in the same vein. So more patchwork regulatory environment, it's going to be great.
Yeah. You know, it might almost be better if they all just adopted the same really hard standard as opposed to different standards.
Well, I think with a lot of large financial institutions, that is kind of what they're defaulting to, because it is completely impractical and unworkable otherwise. So a lot of the larger banks are, a lot of my clients, you know, work at the end of kind of debt recovery life cycles, and they're getting notices from a lot of the financial institutions that they work with saying, we don't care if the request you get in is a California resident or not, send them all to this hotline, send them all to this number. And my suspicion is that they're just going to be treating everything the same, because it's only a matter of time.
Eric, in your world within Yodlee in dealing with data and alternative sorts of data, what sorts of feeds are you guys looking at expanding to in terms of the types of information you're collecting, how you're distributing it, how you're managing it?
Sure. So in terms of feeds, obviously the open banking initiatives that are out there now and very prominent, first in the EU or the UK specifically, but increasingly we're starting to see that here. So in terms of how we acquire data as an aggregator of data is certainly going to evolve. The second thing is really around what we do with the data, right? So it's the enrichment. What we're really focused on is the next best action, right? So it's taking that data and from all the disparate sources and trying to help that customer from a wellness perspective figure out what is that next best action that they should take. And that can be different for every customer, right? So we have customers on our platform, that might have, $50 and they're trying to figure out how they pay their next bill to someone that have 5 million in investable assets, right? So, we're really trying to help that whole spectrum of customers understand and figure out what they do next.
So just to complete the word cloud of buzziest words, we now apply AI and, the idea of behavioral economics. What sorts of things, Gene, are you seeing related to those applications to alternative data, richer data, financial wellness powered by AI? Might as well do blockchain in the cloud as well, maybe throw in some drones. But what are you seeing in terms of the new crop of startups? What are they trying to do around wellness?
So, part of it is there's that journey of wellness to start with financial literacy. Just to add another buzzword.
Yep.
Buzzword bingo for anyone to do it. If you look at that sort of journey and how people are trying to change that, because nobody wants to call it financial literacy anymore. That's not a popular.
Well, because it turns out that it didn't work. Billions have been wasted on financial literacy.
Exactly, right? So it's really getting back to the behaviors. So I think you see a lot of people using the AI tools to understand the behaviors, to collect the data on the behaviors through other sources. So whether that can be, as they're driving and where they're driving to, on their GPS apps, their phone, tends to be a lot of data sources that people are using different, ways as they do in the capital markets world for downloads. Similarly, I think as startups are looking at, consumer behaviors that way as well. So I think you see that. We're seeing the other thing that's obviously prevalent in this space is as you think about the use of AI, that's all day we've been talking about, it's all about the data, right, that you have, right? So how do you ensure you have data that's suitable for these AI algorithms and that don't create bias and, really try to address that. And I think that's coming on earlier in this space about the bias in AI, just based on some of the activities.
Natural lead into what you and I talked about on Breaking Banks podcast last week is AI and the regulatory issues and discrimination. You want to do a recap of what we talked about with the Apple Card?
Sure. So I think unless everyone's been living under a rock or doesn't have a Twitter account, knows that the Apple Card has come under lots of scrutiny. Specifically, we are in the great state of New York by the New York Department of Financial Services for allegedly having a underwriting algorithm that discriminates against women, specifically two rather high-profile women with very wealthy husbands who seemingly have all of the same joint assets, so on and so forth.
One of them actually working with Apple, of course, and for Apple, just insult to injury.
We're not going to talk about that part, but it's nice to know that Twitter can launch a regulatory investigation now. But simultaneously, that happened just a few days after the New York Department of Financial Service had already launched another investigation into some allegedly racially discriminatory algorithms by United Healthcare's Optum arm for allegedly discriminating in favoring white patients over African American patients. So the issues surrounding how the algorithms are built, what data is fed into them, how all of those factors are being weighted, so on and so forth, is now kind of squarely in the crosshairs of the country's most aggressive state financial regulator right now. In my personal opinion, I think they're really going to use this as a way to kind of dig in, use it to do a lot of research. We'll see what comes out of it, but I would suspect that there will be rules and regulations coming out of at least this state in the not terribly distant future about the way those algorithms have to either be tested in advance from a compliance perspective and what sort of measures need to be taken before you actually use them to impact a consumer product or a decision because the laws that regulate the discrimination are not new. They're super old, and everyone should be complying with them. And like we talked about on the podcast, like you cannot say the machine did it, and like we don't know how that happened, because from a regulatory standpoint, that is not going to cut it at all.
Speed round, I'm going to ask the same question of all three of you. Is the insertion of a lot of regulation this early in the adoption cycle of new technologies, is that going to help or hurt this case for inclusion and financial wellness?
I think ultimately it will scare a lot of companies away from trying new things that they would have otherwise tried. I think the CFPB kind of had the right idea. I can't believe I'm saying that out loud.
I hope this is recorded, and I'm going to play this.
With with their no action letter policy, because it allowed an opportunity for an organization to say, here's what we would like to try to do. Can you please watch us to make sure we don't do anything wrong? And then please and thank you, don't find me and don't file an enforcement action. There aren't if other state regulators aren't going to do that, then the CFPB no action policy has far less weight if New York is just going to come after you for the exact same sorts of behavior. So I think it's really just going to scare off a lot of innovation.
Eric, what do you think?
I would agree. I think that it's going to be intimidating in the short term. I think folks that might have been ready to dip their toe in it, right, are going to kind of step back and say, okay, wait a second, do we have to check, what boxes do we have to check, right? So Apple is a great example of that, right? They know all of their devices, they know experiences, but they didn't necessarily know credit, right? And so I'm sure that they hired a bunch of experts, but something was overlooked, right? They missed something. So I think other players that might have been thinking about going into that space, especially on the larger side, maybe a smaller startup might not have the same reservations as somebody like an Apple or a Google or someone with that type of backing. But I think in the short term there might be a little bit of an impact to it. I think long term though, the market is still there. There's an opportunity, so I think it's still going to drive people there long term.
Gene, I think you can answer from both sides, right? You have the data providers, the big companies on one side, and then you have the startups on the other side.
I was actually even thinking, I actually think there's still people who are going to move forward with it. If I'm a large asset manager or financial institution, right, who's dealing with the regulation today, and I'm looking, and I know because I've talked to a couple that are saying, hey, if I look at these market segments, if I want the pie to grow, right? I can't use fees anymore. I can't do this, right? I need to grow the pie. So there's this population that we really need to address. I need to find the ways to address it and to work with them. Okay, is AI going to be the first role of it? Maybe not. Maybe it'll be a different type of product. But I think there's a lot of research, a lot of focus being done on what are the products to service this market, because this is the group we want to bring into our fold. So I'm hopeful.
So if we're really going to try and change wellness and inclusion, Gene, why don't we start with you? What do you think either structurally needs to change in the way the market works or behaviorally in how people work?
First is just that there tends to be a disconnect between people who focus in the capital markets world, right, and then people who focus on underserved markets. And I think that is starting to go away. And I think that's the type of disconnect that is the first step of realizing what the impact they can have to the capital markets arena, right? As more and more money goes private, right, what are the ways to think about this population and how they engage and how they act and how they, as they move forward in terms of what their financial future can be. So I think that disconnect can go away as people see what the opportunity can be for new products and how to kind of bring those forward. Obviously, a regulatory framework. I always get caught up too, just because we talk about data so much, that in the U.S. we still don't even have the basics of you own your own data. Right, and you opt in or opt out. It is your data to do with as you see fit. And if you don't have that basic tenet, it can make a lot of these other technologies and enhancements and outreach pretty difficult. So for me, that's something that I'm always like, what's the best way to get around that?
Yeah. I mean, Eric, you're the perfect example of the merger of these worlds, right? Sure. Literally the merger of Envestnet coming from the capital markets, Yodlee much stronger in the banking side. How have you seen, as it's become Envestnet, Yodlee,
sure,
are those worlds starting to intersect for what you do as well and what your customers are asking?
So in terms of how those worlds intersect, right, it's really that marriage of all of the different transactional and personal information for a consumer and sharing that information with an advisor, right? That's where the rubber meets the road from an Envestnet perspective. But when you start to think about the types of data that we have all different sorts of data. We have 22,000 sources of data, and it's growing every day. And we're starting to see some of the alternative nouveau banks or alternative types of sources of transactions that consumers have. And so being able to expose both the companies that we work with to seeing their customers transacting with startups or different types of banks has them kind of like, hey, wait a second, what are those companies doing that we're not, right? So it's causing those companies to start to disrupt from within, right? So you think of the Marcuses of the world from within Goldman Sachs, getting back to the Apple stuff, but you start to see how companies, right, both from the retail and in the investment sector, are starting to think differently, and how do they, grow their pie, right? There's a bunch of consumers out there that they're not able to reach with some of their core products, so they're starting to think of other products that they can start to offer, and a lot of them are starting to leverage alternative sources of data like we can provide.
Fair. Structurally, what has to change, or personally, what has to change? You don't have to give a regulatory answer if you don't want to.
I feel very comfortable with my lawyer hat on, Jason, and I would appreciate if you would let me keep it. So, truth be told, my job is, as all of these companies are thinking about new ways to, new products, new ways to interact with each other, new ways to interact with different data sources. My job is to make sure that as everyone is doing this, everybody stays out of trouble. Because the last thing you want is for you to have some phenomenal idea and you pour all of this time and money and resources into an innovation only for it to really piss off a regulator. Like, that's not great.
Or worse, hurt people, maybe even cause a global financial crisis, things like that.
I mean,
Okay.
what he said. So from my perspective, I think that because the regulatory framework, particularly in this country, is so fragmented, state to state, the federal agencies, the 7 of them that govern financial services, depending on what you're doing, all kind of have their own views about what is okay to do and what is not okay to do, and they all seemingly want to leave their immortal legacy through their own sets of rules and regulations. That makes things very difficult and very expensive. For me, I think that if we really want to encourage that sort of innovation, a model much more similar to the UK and what the FCA is doing would be a much more hospitable environment, because there is so much talent and so much opportunity here to do that, and the lawmakers and regulators make it really, really difficult. And who knows what election 2020 is going to bring in terms of a change in administration, and then, all bets are off if there actually is a change in administration, particularly when it comes to the use of alternative data. And
Sure.
The CFPB is going to, I'm sure, take a wildly different approach to all of it. And all of that gets very, very political and remains very, very political. Yeah. So.
Well, speaking of some of the politics, open banking was a big political issue for most of the EU. And Eric, you had mentioned you're seeing more open banking coming to the US. What are you starting to see? Because that's one of the things that with the banks we work with, we hear, it'll never happen here because, well, one, we're not going to let it happen. We're going to, lobby against it. Yep. But we're starting to see it actually happen. It's market forces that are driving it.
And that's the one thing about the free markets, right? Is they're kind of looking at it and doing an assessment and saying, if we don't do it, the regulators are going to do it for us, right? Yeah. So I think a lot of the companies that are out at the forefront, right, driving some of the open banking initiatives here, are really they want to control their own destiny as best they can, right? So they've certainly recognized that consumers are using other sources of financial applications that are out there, right? So they're being disrupted from a financial institution perspective between the money and their customer, right? And so their goal is to say, okay, you know what, let me get ahead of this, right? So either I can kind of control what my consumers can see, which might not be the best scenario for consumers, because certainly, if it's my data with a bank, I want to be able to see it wherever I want to see it. But I think what they can control is how they interact with their customers, or how their customers, interact with that financial institution to where they want to see that data. So I think really it's going to be the free markets that are going to dictate it more so here, unless there is a major shift from a administration perspective in 2020. All bets are off at that point, but I think they're going to do it themselves.
Gene, last question before happy hour, so make it a really good answer.
Red wine.
Red wine. And she orders. As you think about some of the shifts that are happening, because you spend a decent amount of time in Europe as well, and you, in some sense, are kind of playing like a mini version of open banking, for a lot of the companies here in what you've been able to aggregate in terms of data sources. Where do you think, this idea and concept of open banking goes in the US?
Well, I mean, I think, like Eric said, it is coming. It is happening. Some of the larger groups in the UK have come to the US and actually said, hey, we have these APIs. We can use them, the global banks, the Santanders,
The BBVAs were like, hey, we had to take the poison over here. We might as well go use it.
Yeah, and I think it's really freeing up for, as they are looking at what are those products they need to have in the future, it gives them an opportunity to experiment. Not only take their data, but then other data sources in order to do it. I think the innovative financial institutions are moving forward with it. They're also looking at startups that are in that space and saying, hey, yeah, we can figure out ways to partner. I do think there's a great opportunity that some folks, and most of the companies I see are coming from other places, about how do you handle data collaboration when it comes to customer data? How do you meet, the California privacy and GDPR? And there's solutions out there that are coming. Some really impressive tech companies like Data Republic, and others that can create these environments where people can collaborate on data that's anonymized, that is tokenized, that actually it can meet all of the requirements. And so we will get there as well, but it just gives a huge opportunity for new tech companies to come in and who can understand the requirements and develop the products.
So I lied. One more follow-on question to that. For someone who deals in data, you're also exceedingly well-versed on the destruction portion of the data. Where do you find these startups are struggling the most? Is it figuring out the compliance piece of it, or is it actually figuring out what they do with the data?
It's probably the compliance piece for the most part, because they're pretty tech-savvy people that could say there's technology to handle it, right, and to deal with it. It's really understanding how do I apply these rules, which is why folks who have experience in financial services are valuable to tech startups to kind of help to match that. But I would say it's more on that side.
Great. Yeah. Well, thank you all three for joining today, and thank you for sticking it out in the audience. Speaking of wellness, the bar will now be open. Go have the red wine, good for the heart. But again, thanks for sharing your thoughts on how we solve the wellness pandemic in this country.